Hope you can all see the screen.
Yeah.
Okay, good. All right, so we're going to go over what we did yesterday. So that was equity valuation. Equity valuation. So this is a simple guide. This has been shared with you on the WhatsApp platform. If you haven't been able to go through it after this session, kindly take time and go through it. All right, so I'll begin with, okay, so the basis is that this is one form of valuation. This is one model. And even with these models, there are a lot of assumptions within that requires a lot of skill, a lot of experience, a lot of understanding in the market to maneuver through. So kindly pay attention. It's a bit tricky, I know, but try and just move with me gradually. As you move with me, I'm sure there are a lot of portions that you understand. And if you don't understand anything, you can get back to me so that we talk about it. All right, so the core challenge, we are assessing GCB's intrinsic value. Intrinsic value is the fair value. Okay, intrinsic value using the free cash flow to equity. That's the first part of this lecture. Then the discounted cash flow method. So free cash flow estimates the cash that is available to the firm for management. Free cash flow to equity. Okay, then when we are done, we forecast this free cash flow. When we are done forecasting it, we bring the forecast back into present value terms. We compare it with the outstanding shares. Then we make a decision whether the share price compared to what is happening on the stock market is fair. Our goal is to uncover GCB shares. If GCB shares are currently undervalued, overvalued compared to their true worth, whether they are currently undervalued or overvalued. So our approach, as I explained, we're going to project the FCFE, all right, from 2026 to 2030 using the historical. So historical is 2021 to 2025. It's always based on the history that you can project. If you realize when you are going to be employed in any firm, we want to know what you have done before. So your CV tells us that you can do this, that, or that. If there's no history, we can't project. We can make a lot of assumptions. In this case, we want to use the historicals, what GCB has done before. We want to assess what you have done before. Based on that, we want to do a projection. All right. With this analysis, I put an assumption of 15%. 15%, meaning that whatever GCB has done in the past, I'm expecting that their free cash flow would grow by 15% on an annual basis. 15% on an annual basis. And then discount it back, or discount these cash flows back to the present value terms using the cost of equity. Using the cost of equity. The cost of equity, we got around 23.08 thereabout. Okay, that's what investors are expecting to get from investing in the company. So we went into it the last, I think 3 days ago. On Wednesday, we went deep into it. All right, we'll go over it on Saturday. Kindly make a date and join. So the verdicts calculation yields an intrinsic value of 64, significantly higher. So I made mention that these approaches, there are various approaches to go about them. How to even get the components. Some of the components, they are quite straightforward. Some of them too, you have to use some experience to get the right estimation. Some experience to get the right estimation. And whatever outcome that you get, it has to make sense. It has to be reasonable. Okay, I gave the example of Snapchat. I'm going to mention it again. In 2017, when they were going to be listed, a number of firms Okay, as is done all the time. When there's going to be a listing, investment firms, they do evaluation of that company, and based on the evaluation, they advise their clients. So a lot of these firms did their own valuations, and they got various values, right, of the same firm. All right, this Facebook too, when they were coming to the market, they faced a similar challenge. There was one firm that mentioned that Facebook is not the price. The price that is being quoted to be listed is not a fair price. It is overvalued. Another one also came out and said, no, we are seeing great inflows from adverts. We are seeing great inflows from adverts. So based on this, we can say that it is a viable, it can turn around the business of Facebook. All right, this was around the time that valuation was being done for this institution. So it could be that another company also made its own analysis and come up with a different outcome. So based on your understanding, based on your skill, okay, based on your experience in the market, you're able to make reasonable assumptions to get viable intrinsic value for your stock, fair value for your stock. It has happened in this country several times that IPOs, various investment firms come up with their various values. But in the end, we have to look at a lot of things like the market premium. Market premium is also very important. I remember when MTN was coming to the market first, some people thought that the price was a bit high. Some people thought, but they came up boldly. Okay, spoke about it. It's a valueless estimation. Okay, but lo and behold, I mean, whatever it is, the market premium for MTN is so high. Even now, it's so very high. And how do you calculate that? So we have to be very deep thinking when we are going about this analysis. Now, the first step, we're going to calculate the free cash flow to equity, the free cash flow for each year from 2021. So column 1, the table below, column 1 is the year, column 2 is the net income, 3 is the non-cash charges, 4 capex, 5 change in working capital, 6 is the net borrowing, then the last one is the free cash flow to equity. Free cash flow to equity. So that's the formula you can see right after the header. The formula is free cash flow to equity, net income plus non-cash charges. You take out capex and you take out change in working capital, then the net borrowing. The main challenge for this thing I see, or with my experience, suggests that it's how to identify these components. How do you identify these components? So I'm going to use the Excel to help. All right, after I've gone through this slide, I'm going to use the Excel to help so that we try to understand or where to pick them from. Once you're able to pick the right figures, that will determine your value at the end of the day. All right, the values that you pick is what will determine your value at the end of the day. So net income, we all know where to pick net income from. Non-cash charges to normally the depreciation, amortization, capex, capital expenditure, working capital, change in working capital. Normally, so sometimes we use the current assets minus current liability. What is left to manage the business, that's the working capital. And the net borrowing. Okay, some of these components are directly in the financial statements. Some of them too, you have to work around it together. So I will go through with you at the end of this presentation. Now, there's the formula for the DCF. As I said, after you've gotten the free cash flow from this step, you have to forecast these figures at 2021, 2022, up to 2025, forecast them into 2030. All right, so we'll do the forecasting based on our assumption of the growth rate of 15%. And then when you're done with that, you discount these values into present value terms. So using the cost of equity. So this cost of equity is calculated using the CAPM. CAPM is the capital asset pricing model. Okay, and it is gotten by factoring in risk-free rate. I think we went into it the last time. Risk-free rate, you add beta, then you multiply it by the equity risk premium. Okay, and then that one I directed you to Daran, the website. Okay, the risk premium, I was using the average of the market return over the last 5 years. You can also be picking it from here. It's allowed. I mean, you just need to find out how they got it. Go deep into it and find out. Maybe the contact session, contact them and try to understand, so that if you are asked, you know how to explain. But I'll prefer to use my own data. That is why I pick from the average performance over the period. Right. With all of these things, the most important thing is to be able to explain what you have done. Now we move to the perpetual growth rates. This steady growth rate for cash values beyond the forecast period, and this figure is normally the GDP growth rate. Okay, GDP growth rate, and the forecast period normally up to 5 years. So if you do a trend analysis of 5 years, the forecast typically, if you make it 5 years, so analyze 5 years in the past and forecast into 5 years. That for me makes sense. Then the outstanding shares too, we know where to pick it from. I go to the GSC website, Yahoo Finance, so you can get it from there. When you go to afx.kwaec.org, the figures too are there for you to pick. Now this is the forecasting, and that is the formula I made mention that the formula is a future value formula. Those doing finance are familiar with this, but if you're not reading finance, it's as simple as you can see on the screen. So the base amount is the 2116947. So once you get 2025 value, use the 15% to start projecting into 2030. So we project ECB's free cash flow to equity for the next 5 years, assuming a consistent annual growth rate of 15% from our base year 2025. So these projected FCFE figures from the foundation of our valuation representing the cash expected to be available to equity holders in each future value. Now, the next step, we take each forecasted FCFE and discount them back to present. We discount them back. This is the steps. The first option is to memorize it, but you don't need to chew it in your head. Try to, you just have to practice it every time. Once you practice it every time, these things, they become handy. Okay, so we are saying that the next step, once you are able to forecast, then you discount those forecasted figures to present value terms. So the figure for 2026, you discount it to present value terms. So the discount rate, that is the 23.08. That is the figure you are seeing there. So free cash to equity, this is the formula, divided by 1 plus 0.23. So 1.2308. That is, you are bringing it back to present value, and time is 1. So you apply exponents. So all the exponents, you apply them. Once you apply them, you are getting these figures. We'll demonstrate this in Excel for you to appreciate it or appreciate them better. So this means that 4.2 discounted into 2025 is 1.4. So column 1 is the forecasted year. Column 2 is a forecasted free cash flow to equity. Column 3 is the exponential figures 1 to 5. So if it's year 5, you discount using exponent 5, and the next column is the discounted values. Okay, now we move to calculating the terminal value. So after you've done this discounting to present value, you will find out what the terminal value is. Now, the terminal value captures the value of all cash flows beyond the forecasted period. So from 2030, what is going to happen from 2030 onwards? That is what we are trying to estimate. You see, all of these things, you wonder whether it makes sense. Okay, because we want to buy an asset today. In Ghana here, our market is very volatile. So why are we trying to use all these methodologies? So if you are saying you are forecasted to 5 years, why do you want to know from 2031 to infinity? What is the essence? All right. So these things, that's why I keep saying that they are estimations, they are assumptions, and valuation is all about that. Okay, so you have to use some skill, and the idea is that once you're able to get what to expect in the future and discount it to today's value, that will be the fair value, because that means you are planning to hold the asset over a longer period. Okay, over a longer period. So from 2031 to infinity, it assumes the company will continue to generate cash flows at a stable perpetual growth rate. All these valuations, they have their issues. All right, they have their issues. So what if, for example, in the market we had UT Bank listed on the market. Activities were going on before UT Bank got listed, or before their licenses got revoked. UT Bank recorded a lot of trades on the stock market, and financial analysts were making their own projections on them. Then it went off. Probably, at the time, I didn't make any evaluation, but I think, or I want to suspect that at the time, somebody was making this same evaluation on it, that 5-year projection, then the infinity, how to calculate the terminal value, and they were all bullish about it. But we woke up one Monday morning and we heard that UT Bank's license has been revoked. All right, these are risks. These are risks. We can't say that because this thing will have a own value. We'll go ahead and value whatever it is. We'll talk about it. But as it stands now, this is the valuation of GCB. Figures that you have at the point of the valuation, or at the period that we are doing this valuation. This is the position. That's how you should always go about it. All right. So the terminal value. This is also the formula. Okay, FCFE as at 2030 multiplied by the growth rate. So you're going to find the future value. Okay, and it comes up to 4.257937. No, sorry. There's a 4.257 is the forecasted figures at 2030. Then you find the infinity as in the growth rate using the terminal rate. Terminal rate is the GDP growth rate. Now you put them over 23.08%, that is discount rate, times 4%, that is terminal growth rate. Then the value you get is 23. Sorry, 23,198,997. So that is what we call the TV, or the terminal value. So this means that all GCB cash flows from 2031 onwards, growing at 4% annually, are equivalent to 23,198,997. Okay, in value at the end of our forecast period in 2030. All right. Let me drink some water. All right, so moving on to the bringing the long-term value to present time. So when you are done with finding the terminal value, you have to bring this value to present value terms. So you realize that there are two stages here in bringing values back to present value. The stage one is after you've forecasted, you bring all these values individually back to present value, and that's what we've done in this slide. Now, in finding a terminal value too, when you have a figure, you have to bring it back into present value terms. So this is what you do. So we still have to apply the cost of equity. Okay, and with that too, we use the exponent of 5. So present value formula, 23,198,997 divided by 1.2305 exponent 5. Now we get 8.4 there. Okay, so stage 1, each of the future value, as you can see, estimated future values, cash flows, you bring them into present value. Then the terminal value, after getting your figure, you bring that one to also into present value terms. Now, let us continue. So the grand total and the final share price, with all the components calculated and discounted, we can now sum them to arrive at the total present value to equity, and then divide the total number of shares to get the intrinsic value per share. So now this is it. Total present value forecasted is 8.5, as you can see, 8536990. Total present value of the terminal value is 8418. So 8536 is all the future cash flows forecasted put together. Okay, if you have a calculator, you can try your hands on it. So this is the 1977080. You add that column to the end to 1.4. After adding it, you come out with 8.5, 8536990. So this is it, or this is it. Then when you have to take into consideration the present value of the terminal value, that is 8.4, as we got in this slide here. Now you add the two, total present value, you add the two, you come out with 16.9, 16,955,924. Put them together, then you divide it by the issued shares. The share price, or your estimated share price, is as shown. So by dividing the total value of equity by the number of shares issued, we arrive at the final estimated intrinsic value per share. Final estimated intrinsic value per share. This is estimated. With our estimate compared to the market price of 9.54. This suggests GCB is significantly undervalued according to the FCFE DCF model. Okay, so I think yesterday I was stressing on some words here. So for example, I was saying that compared to the market price of GCB, this suggests, so the word suggests, you see, it is suggesting, this formula or this approach suggests that GCB is significantly undervalued according to, so there can be according to a number of according to's. Okay, we need mention of the RIM, residual income model. So according to the residual income model, what would be the value? According to the FCFE DCF model, this is the value. So the approaches for investment or for the valuation determines what you want to look at. But the point I'll make, GCB as a bank, DFE is not the appropriate model. Banks. It is not. It is not the appropriate model to estimate banks. For banks and financial institutions as a whole, the recommended approach is the residual income model. The residual income model. And if your institution or the bank that you pays a lot of dividends, or they are consistent in dividend payment, then you can use the DDM model. Or the DDM is structured like this. It's the same approach, like picking the figures and stuff like that. We'll go through it basically, so that if you have time. But this forms the basis, the intrinsic value, the FCFE approach, the basis. It makes you understand. It's quite the most complex of them all. That is why I'm trying to let you guys understand. So if you have an institution that has a cash flow cash flow in the past, then this is the right model to use. For banks, because of their cash flow, their working capital issues, which is not very consistent, which sometimes is a bit volatile, this approach is not the best. Okay, so what figure we are getting here? The analysis that I did regarding GCB that I shared with you, I didn't share on your platform, that I showed you during one of the presentations, that I did one for residual income, and that figure was around 10 cities thereabouts. Right? And the intrinsic value approach I used for the other one too, I got around 21. So depending on the components that you select, that brings out the right or the fair value. It makes it more clearer. I'll pause here to take questions before I move to the Excel.
Hello, please, I lost you. Can you repeat when you said there are some models are advised and no advised? Can you please repeat that statement?
Come again.
I'm saying that I lost you a bit. As when you were saying that you can use the residual model or DDM. Like you were saying that this model is not good for certain institutions. Also, I lost you. So if you can repeat what you said over there.
Okay, so what I'm saying is that each of the models, we have industries that are applicable. So for example, banks and financial institutions, the FCFE is not the best approach to use. For the banks and financial institutions, FCFE is not the best approach to use. Advisably, the best, or what is expected, or what is the best approach, I'll say the best, put in quotes, okay, would be the residual income model. We'll go into that one. That one is a separate valuation approach. Okay, so for institutions that have consistent cash flow, excuse me, let me take some water. You guys, sorry. All right, so going back to what I was saying, the valuation models, we have industries that you can use, right? For FCFE, you need to use institutions that have a cash flow, consistent cash flow, and they are consistent with probably, you can talk about dividend payment. When cash flow is not an issue for institutions, this approach is best applied. However, what I'm saying is that for banks, cash flow, sometimes working capital can become a bit of a challenge, because for banks, their main liabilities are the deposits. So as you have a lot of deposits, it's expected that they will run the business out there. There will be a lot of funds available in case there's going to be a collapse. Okay, there will be available funds to pay out. And normally, for banks, when they have a lot of cash available, deposits, there's a percentage that they give out as loan. They don't give the entire deposits out as loan. So what if there's a collapse or all customers come in that they want their money, which normally doesn't happen. Not everybody will go out and say, I want my money, right? So in that sense, there is a record of negative working capital. Working capital for banks, or generally, it is calculated as current assets minus the current liabilities, which deposits form part of the current liabilities, which I've explained that normally it is a large figure. So typically, it always comes in a negative. And if it is a manufacturing or any other firm, negative working capital can be problematic. Negative working capital can be problematic. But for banks, we say it is not a problem. It is not a problem, depending on where or how they do their asset allocation. All right. So for a bank, they have to give out good loans. They have to purchase good investments. It has to be in a way so that the bank does not collapse. So working capital aspect of the component of this calculation, as you can see, I think I showed you the formula here. So working capital here, it's normally an issue when it comes to the FCFE, calculating the FCFE of a bank. This is the main challenge. And based on even this, different valuers or analysts can get various figures. One valuer can just rely on the loans and the deposits, loans and deposits. Another can use the entire current assets and the entire current liabilities. And another valuer can also rely on figures in the cash flow statement. So depending on this, it's a bit complex. It makes it a bit complex. Depending on what you select, it informs the value or the intrinsic value, the final value that you are looking for. Okay, so for banks, typically we use the residual income model. Residual income model. If you have a bank that pays very good dividend and consistent, not very good, but consistent dividend payment year in, year out, you can use the DDM approach. For DCB, even the one that was announced this year, it hasn't been approved yet by the Bank of Ghana. The last time I checked, it hasn't been approved yet. So even though the company, board of directors, shareholders have approved that they want to pay 1 cedi per share, which because of that information, share prices have moved so high. Not because of that, but it's part of the reasons that share prices have moved so high. The Bank of Ghana is here to approve it. And in the previous year, there was no dividend payment. The 2 periods, there was no dividend payment. All right, so it's not consistent. So this tells you that even with cash flow, it hasn't been very consistent, and this approach is not the best. I am just teaching you the steps. Pay attention to the steps in calculating it, and try to apply it in your own analysis going forward. I hope I've answered your question.
Yes, you have. Thank you.
Right, sure. All right, Oprah, Dennis Oprah.
Okay. Please, my question is, you see, you were talking about GT Bank when it collapsed, and I want to ask that
UT Bank, sorry. UT Bank.
Yeah, UT Bank. Yes. So when a company is delisted from the stock market, is there a way that they compensate their members, or once the company is delisted, that means you're losing everything?
Okay, so for you to buy shares of a company, it means basically you are part of the owners. You are part of decision making. You are part of the businessmen in the company. So if a business, or if the business collapses, if it collapses, the assumption is that you understand you are part of the decision making process, because there are AGMs. When decisions are being made, you are there, you participate, you contribute, and you are privy, you see the financials and all of those. So if it collapses, you are part of the reason why it collapsed. All right, so for compensation of shareholders, there's nothing. But there are levels of compensation to stakeholders. For example, if you are giving the bank a loan, Not so with 10 meters, maybe you've invested a repo, you've invested in some FDs, like those things. So in times of liquidation, these are the processes that they go through. So the debt holders are attended to. Then it comes to preference shares, then from there equity. So the equity holders are the last people that we look at. So if there's nothing to give, equity holders don't get anything. But it is the debt holders, those ones in the process of liquidation, it is possible that they can get at least the principal amount of what they invested in the business. Then is it clear?
Yeah.
Thank you. Gio Kobe.
Good morning, Kofi.
Hi, good morning. Good morning.
Please, I hope you're well.
Yes, Samuel. Thank you.
Oh, okay. I had two questions, but Okra just asked the first one. The second question is about the intrinsic value. So,
Okay.
per my understanding, intrinsic means the true value of the stock or the shares. So, if per the calculation that we just did, if GCB intrinsic or the true value is at 64 cedis, why is it that the stock market hasn't realized the 64 cedis as the true stock value, but trading at 9 cedis at the moment?
Okay. I'll explain that to you. All right. So the stock market is a platform where buyers and sellers, they meet to trade, basically. And in the trading, there are a lot of sentiments, or there are a lot of factors that go into the decision making of the market. So sometimes maybe somebody wants to go and purchase, maybe a shareholder in a major institution, maybe MTN. He's found an asset somewhere that he wants to go and purchase. One shareholder, he has a lot of shares. Based on that reason, he dumps his shares on the market, and somebody buys it. And dumping your shares on the market too, you know how it is. Once you dump, you are desperate to sell. It affects the share price. You move the share price down and stuff like that. And many others can have various reasons why they sell their shares or why they buy. You have various of them. Okay. And we are saying that this process or these reasons cannot be calculated. And they may impact the true value of the share. Okay, so all these reasons, right, they determine what is happening on the stock market. Another thing is a company like GCB. In the last presentation that I did, I pointed out that there is what we call the liquidity risk. Liquidity risk, as in the availability of the stock to trade on the market. So as it stands now, there is a lot of demand. A lot of people want to buy the shares of GCB. However, those who have the shares or the shareholders in GCB, they are holding on to the stock with the hope and belief that it is going to rise so that they earn more. Because of this challenge of buyers struggling to get shares to buy, there's a stalemate. And the price is stuck as where it is. All right. Until there is buying and selling, the proper price discovery will not be achieved. Until there is buying and selling, price discovery will never be achieved. So GCB is 9.57 because of one of the reasons that I've mentioned of liquidity on the market. Okay, so it's 9.57. The true worth is about 60, as I've mentioned. So how do they achieve it? There has to be a lot of transactions on the market. So it's a challenge. It's some of the challenges that they go through. The market, stock market, at least it has to be trading at a premium. At least. All right. If you check the price of MTN, the last time I checked, I think the first quarter analysis that I did, I realized that it was trading above the intrinsic value. Typically, for an efficient institution, that is how it's supposed to be. There has to be a premium on it. Okay. But if it's trading below the intrinsic value, it means the underlying issues, right, as I've pointed one, with the liquidity. So you won't have a situation where the price would be the same as the market price, as the book, as what you've calculated. It typically is not always the same, but it should be within a range. It should be within a range so that shareholders can effectively do their transaction. But as it stands now, because of the main reason of liquidity on the market, the price discovery of GCB may be difficult to achieve. And it's not the GCB, the EcoBank Ghana and Standard Chartered Bank. There are a number of them like that. There are a number of the stocks like that. They are very good per their books. They are very solid financials. However, on the stock market, you realize that they are trading way below their intrinsic value because of the challenges that we face as an industry. Kobe, I hope it's answered.
Oh, okay. Yeah, it's answered. But when you were answering the question, I found another question in there where you said the buyers and then the sellers, or those who are willing to buy, or the demand on GCB are not being fulfilled just because it seems, if I do understand it well, some other folks are holding on to the stocks, and that's holding the activities on the stock market. But when you check the AFC Quasi, the review or the overview sites that you shared with us, there is an outstanding of, is it 2 million shares, or I can't get the figure right, but roughly it's around 2 million shares. And from my understanding, outstanding, or let's say outstanding, has to be maybe a pool where you can put in money and then buy, or there is stairs for you to buy. But when you were talking, you said buyers are willing to, or there is a demand on the shares, but they are not selling, or they are not getting to buy. So what is the essence of the outstanding shares if buyers cannot buy from the outstanding shares?
Okay, so I want to display the screen so that you take us through what you have seen. Then I'll explain. Let me share this screen. Okay. So where are you looking at?
The shares outstanding. That's after the dividend yield.
Okay, this is what you're talking about.
Yes.
Okay. I would like one member from here to explain this for me. Please, any of you. Gio Kobe is talking about outstanding shares of 265 million. Can any of you?
Can I give it a try?
Yes. Go ahead.
So when we say shares outstanding, you refer to the total number of shares, equity shares. Those are the equity holders, what they own in the business. That is what share outstanding means. I don't know if I have answered the question.
Yeah, I think it's quite good. Any other person?
I think shares outstanding is the total number of equity shares available for trading. It's like the share available for or something.
Okay. Gio, I hope you are following.
Yes, I'm following.
Okay, all right. I need a third person so that I come in. Third person.
Kofi?
Hi, Harry.
Yeah, I think the shares outstanding is the total number of shares that is available to the public for trading.
Okay, good. I think you've all done very well. So, Gio, this is it. So before the company came to public, this is the number of shares that they made available. So all these shares have been taken by investors. So until one investor says, I want to sell my portion, it is not available to be sold. You understand? So it doesn't mean that doesn't mean that it has to be on the market. So a new buyer, before a new buyer gets the shares, a holding shareholder, somebody who's holding the shares, has to release his portion before it is bought. I hope it's clear.
Yeah, I do. I understand.
So your colleagues have given the technical meaning. I'm giving you a meaning that will make everybody else understand. Okay. So all the shares available for trading is 265 million. Until any of the shareholders release their shares, whoever wants to buy the shares cannot get them to buy. It is closely held. All right. Any more questions?
So for you to buy the shares, you have to put in maybe a pending order till someone sells and it fills before you get the shares.
Yes. Typically, that's how it
okay.
is. Place an order, and your price has to match whoever is selling's price before it goes through.
Oh, okay.
Okay.
Thank you, sir.
You're welcome.
Okay,
Adike.
okay.
Yes. Hi.
All right, so well done. Good morning, everyone. So I don't know if this has been answered before because I joined in late, but you talked about the best valuation methods for banking. So I want to know, are they the same for insurance companies too, or the insurance companies also have their own unique best valuation methods? Thank you, sir.
Okay. So from what we know, for financial institutions, the residual income is the recommended approach. Residual income model, RIM, is a recommended approach or the recommended model for financial institutions. Okay, so it's not banks and insurance companies. So for all financial institutions, that is the recommended model, RIM. We'll go through it, but let's not jump too fast. Let's just go step by step so that we don't confuse ourselves. Jeffrey, you're welcome. Jeffrey. Hi.
Yeah. So when you're you're starting the evaluations as a non-financial. And then so I'm also asking, I don't know if you answered.
Okay.
Hello?
Yes, go ahead.
Yeah, so I don't know if you answered yesterday, but then I'm also looking at it from another angle. Can you base your valuation on what you expect, as in capital gains or dividends, rather than the industry? So let's say I'm making an investment. I want dividends, rather, no matter the industry, as long as I want dividends, I want to use the DDM approach. And probably maybe if I want capital appreciation, no matter the industry, I'll use probably another valuation method instead of going industry by industry. Does that work?
I want to say that you have to use the right tool for the right job. So if it is a cutlass that you want to use to weed, you use a cutlass to weed. And as I said, I mean, you can use these ones. I used it, but I didn't use it alone. In the last presentation that I did, that I shared with my investors, I used the FCFE for both stand charts and the GCB. However, I added the target price, the earnings per share, okay, and the forecasted figures to get the 1 year price and the 2 year price. And I also used the RIM, which is the recommended one. So in doing your presentation, you can have 3 valuation models applied. You can't, not say you can't, you can, of course, but to show that you are very skilled, you have to apply at least more than one. I don't have to give a figure so that you guys are going to quote me somewhere that I said at least 3. No, it has to be more than one. It has to be more than one so that you will know your versatility. You have to be versatile in these valuation models. So I chose 3 models, and that is what I used. And all of them showed that, in fact, there are 4, and all of them showed that GCB is woefully undervalued.
Okay.
Yeah. Okay. Dennis.
Okay, Kofi, it's a follow-up question to Kobe's question. You see, he was asking about when people are looking for shares to buy and they are not available on the market. So I want to ask, you see the outstanding shares, that is the shares that the company made available when they were newly listed. So I want to ask that now that people are looking for shares to buy and they are not getting, can't the company maybe add up more shares? I mean, the outstanding shares, can they expand it?
Yes, it can be done. And you see, that is why we are looking for critical thinkers like the way you are critically thinking. All right, all of us here, we have to make some decisions. So I am a pension funds manager. All right, and I have a skill of financial analysis, valuing companies, and all that. But that is not what valuing company is not what I am typically expected to be doing. You understand? So for a company to issue more shares onto the market, it has to come from somebody to advise. And there are people who are advisory firms. There are institutions that are licensed to be doing these things. I speak to those who are licensed to be doing these things, and we are still waiting. Okay, the company is there as GCB, or the company is there as EcoBank, whichever, they are there. An advisory or an advisor, once you guys, all of us, you grow, all right, you understand the market properly, you do your analysis, you can send a recommendation to these companies that, no, based on these reasons, I think you should issue more shares onto the market. Issuing more shares, what does it mean? It means you can do a right issue. These are different aspects of all the conversation. You do a right issue, a bonus issue. If those reading finance, I'm sure they might have met it somewhere. A bonus issue, a right issue. And with this approach, the share price typically comes down and more shares are issued onto the market. With more shares being issued onto the market, new investors can come in at a lower price. Then it's more inflow for the business, more liquidity for the business. You understand? So it's very good you are thinking along this line. I'm happy you are thinking along this line. And I'm hoping that one day, all right, you stand up and make these recommendations very boldly, and you call me to assist you. I'm always available to any of you who decides to take up this kind of topics in the industry. Okay, so, okay, well done. All right. So we have Gabriel. Is it Gabriel? Yeah, Gabriel Wusu. Gabriel, your hand is up. All right. If Gabriel is not ready.
Kofi, thank you for the presentation and also the advices that you have been giving along the line. I have a question, and the question is, years back, we saw Car Bank release a right of issues of shares, and since that time, the market price of Car Bank it went up and it has been decreasing along the line. People were blaming the right of issue of Car Bank that caused the share price to drop, and because of that, most people are now undervaluing the company. That because of what the bank did, they are floating their shares. And I'm asking if the right to issue or the right of issuing a share is the best approach. Why does it negatively affect the market? Thank you.
Okay, so when Car Bank was doing its right issue, I was one of the few analysts who came out boldly to say no. Investors should be cautious of going into this transaction. I was one of the very few, and I don't think I have any regrets. The issue for Car Bank has been a cash flow issue. And it came out from the financial sector restructure, the DDEP. from the records that we saw, they had a big exposure in government instruments. So therefore, when government decided to do the restructuring, it's hugely impacted them. So at the point in time, I pointed out to shareholders that you hold on, don't do this transaction for now. All right, and I don't regret it. But if you look at after the right issue, let's say the beginning of the year, it was around 35 pesos per share. Currently, around, let's say, 50 pesos. And year to date, the return, let me see the calculation that they have here, 47. Okay, year to date is 42.9. I don't think this is a bad return. I don't think this is a bad return. And currently, I am taking the data of Cowbank. All right, as of yesterday, that is what I started doing. And I'm hoping to get something good from all that I am seeing. Okay, so right issue sometimes. Okay, so this is Cowbank. That's the data for Cowbank. I hope you can see the screen.
Yeah, I can.
You can see the Excel, right?
Yes, please.
So I want to just go through with you briefly, so that we see how this institution has been performing. So this 2025, the current. So see, shareholders' equity in 2019, it was 829. Let's say 800 million, came to 1.03, 1.1, 1.3, and huge drop. This was around the time that they were coming out to do the DDP. So as you can see here, retained earnings to see the trend, it became a negative, and it's even deeper here and deeper. Right. So how has been going through its challenges. So around this time, they came out that they wanted to do a right issue. And for me, it was a bit risky. We didn't know the path going forward, even though cow will not die. Whatever it is, it's a bank. And banks their cornerstone is what? Deposits. Once deposits. So you can look through the financials and the deposits from customers. You can look at the trend and see how it is going. So let's say from here to here, 3.7, 3.6, 4.5, 5.1, 6, 7, 8. It looks good. It looks good. And we can look at the other portion, that is the loans. So loans and advances to customers. Does it look good? Let's print here. So for an analyst, sometimes you don't have to finish the full financials analysis, but you can just do a snapshot analysis and make some few decisions. So let's say this is 2.4 billion, 2.7, 2.2, 2.83. It drops and it drops. All right. So you have to look at it critically. Right issue is a good step for banks to raise additional funds to invest. Okay, but for the market, if there are so many shares, there could be an issue of over dilution. Okay, Cow has its own issue. That is why the price is coming down. However, the main reason why the price is where it is the confidence that investors have in it currently. Right, they have to show more grit. Okay, going forward. So there has to be aggression in deposit mobilization. There has to be aggression in giving out loans to give investors the comfort. Okay, giving out good loans is very, very crucial. You have to show that your NPL is not rising. It's at very, very good levels. These are some of the few things you have to look at. We will go into Cowbank. You can start working on Cowbank, but the reason why the share price hasn't been very bullish is about the operations of the business itself. It's not about the right issue. So I've shown you that after the right issue, even the price has gone up. Okay, it's gone up between 37 or 35 pesos to 50 pesos, which is a 42.9, and even a 1 year trend has been 47. Okay, we have to see more positives in the financials for investors to come jump into it. For right issue, bonus issues, it's not, there should be reasons. So I made mention of one of the reasons of the market in relation to GCB and the stand chart. Those were some of the reasons, but there are a lot of reasons why institutions raise funds. And Cowbank, like I've mentioned, because of the situation that they found themselves, they needed to raise some funds to reinvest or re-inject some more funds in the business. Okay, that is also another reason, but the whole assessment has to be done to be able to approach a business to do a right issue, a bonus issue.
Okay, thank you so much.
You're welcome. Jacoby.
Yeah, Kofi.
Yeah.
Please, I wanted to ask this question when we were done with the analysis that's for the whole month. But when one of our colleagues asked about increasing the outstanding shares to dilute the market so that investors or new investors can buy onto the stock. I wanted to ask, we have the PERSI site for overview and then the stock, maybe stock analysis and all, and we have the annual report for downloading the annual report to assess or make analysis on your own to get into the finance or the engine of the company. I would like to ask, is there any site like maybe Yahoo Finance or Bloomberg where you would just get a first-hand news on what the company is about to do, that's the Ghana company is about to do, so that you make a first-hand decision than hearing from their annual meetings?
Okay, so it depends on where you're coming from. Are you coming in as an investor? Are you coming in as an analyst? Are you coming?
No, as an investor, yeah. Let's say as an investor.
Okay, so as an investor, I would recommend that you see the people that are on this platform. I'm sure any of them will have their own platforms that all this information will be available. So you contact them and take your data from there, because you know that you are the same brackets or the same circle with them. They know their stuff. So this is a platform you can trust. You can use, I think Bloomberg is one platform that is used. Yahoo Finance, I found out very recently.
But do they cover Ghana stock, Ghana markets?
Yeah, I saw. I think I saw it. I saw GCB there.
Oh, okay.
It may not be the day-to-day, but I mean, it's a lot of information.
Oh,
but
okay.
you are being trained here, so why don't you come out with your own data, your own analysis? When you are done, then you can be checking around what others have done.
I'm even talking about, let's say, a news, maybe the company has decided to issue more shares so that shareholders or new shareholders can buy into it. So maybe there would be a news that the company is about to do this, so that the whole, like MTN did, announcing everywhere that they want to make their shares public, and then everybody started to buy. Let's say there might be a one website where all these information, so you can just go and read daily about what the company is about and how to go about. That's what I mean.
Okay. You know, this country, sometimes it's difficult to come by some of this information. And for this information that you are referring to, for me, typically, it's the main media stations that carry this information first. But getting a dedicated platform that has this information, yes, you have to just be attentive in the news, because there's no dedicated platform. It's a business idea too. You know, you can create a platform where all this information. That means you have to do a lot of work. You have to be close to the MDs and the CEOs the head of finance of all these institutions, so that once you get the information, you put it there. As it stands now, so far as I am aware, okay, that there is no one area that we can go to.
Oh, okay. Thank you.
If you find out some,
Please, yeah,
Hi, Jeff.
Plato. Yeah, I'm
Jeffrey.
saying I want to ask something relating to his question, but then I want to make sure I have his question correct. Is the question that can you get certain financials before they are made public, like before the news carries them? Is that the question?
Come
Hello?
again.
I'm saying that I want to say
Yeah.
something about the question, but I want to confirm if I had the question right. So I'm saying, is your question about can you get the financials of companies before they are being carried in the news?
Not the finance, but the activities happening in the company.
Okay, so that probably you make investment decisions on them.
Yes.
But so continue. So my question is also isn't this more of insider trading, like getting certain financials or certain information about the company? For example, maybe Momo will be splitting tomorrow, and then it's not public or it's not in the news. Then probably you know and MD tells you that Momo will be splitting from MTN tomorrow. Then you buy shares or you sell shares. So isn't that insider trading?
Yes, it is. It is straightforward as that.
Yeah. So I think with what he's saying, if it's relatable, then what he's saying is more of insider trading, which is illegal.
Oh, no. Okay, so I mean, from what I understand from what he's saying, there has to be a platform where you can get regular information. So let's say if it's FunWork, this is the platform you go to. There's always information there. I mean, it has to come from somebody who is within and who has accepted that whatever information is given to you can be made public. Unless you work within the company, let's say you are the head of finance, you've seen all the figures, all right, and you have some shares in the company and decide, Charlie, let me sell my shares. That is the typical insider trading thing. But once you interview the person and then the person has kind of confirmed that, oh, this, it can go out. I mean, there's nothing wrong with that. I hope you understand.
Oh,
Yeah, Kofi.
Hi.
Please, does business and finance time cover for the question you asked? Do they do that? Because I think they also publish news about the finance sector.
Yeah, they do, but I'm not sure the information that we are looking for. They call me sometimes give out information, stuff. It's after I'm done with the analysis before I give out information. All right. So we here, we are in the same bracket. You can all come out with information. And when they call me, I can say, oh, speak to Jeffrey, oh, speak to Harry, speak to Gabriel, speak to that and that. So that platform, I'm not sure. It's after information out and out. That is when they get it, because they call industry people. The industry people that they call.
Oh, okay. Thank you.
It's one of them, but it's not the sure place to get all the information that you need to make a lot of information like we are looking for. We want the core information, but yeah, that's all I can say about it.
All right.
Okay, so it's 8:45. I have a meeting at 9.
Just more to what Jeff.
I have a meeting at 9, so
I wanted to ask something small to
right.
submissions to Jacoby's question.
Oh.
I see on the Ghana Stock Exchange market, the Ghana Stock Exchange, when you go to the platform, that's the media. We have press releases and some announcements and those things. So sometimes they can release some information about the company outside their annual financial statements.
Okay. I hope Joe is available and is listening. Joe.
Yeah, yes, I am. Yeah, yes, I am.
Okay.
But I feel those announcements are always delayed. they come later when and as you said, the liquidity aspect or the volatility aspect. Last time you were talking about the incident that happened at Guel, and it didn't have any impact on the market. So sometimes the news will come, but it doesn't reflect on our market as it would on foreign markets.
Yeah. But if you want daily updates of share prices and instant access to financials when they are released, you can give your email addresses to Jeffrey. You can give your email address to Jeffrey to forward them to me so that I give them to the Ghana Stock Exchange. And then you start receiving all those information. Okay, so I have about 30 minutes to enter into a meeting. Gabriel.
Okay, the questions
Gabriel.
When you were presenting on the GCB where the sellers are not selling for the buyers to buy, I have the question that with your years of experience, checking the behavior of the markets, when is the right time for you to maybe, for example, last time you made a statement that normally after when they are going to pay dividend, people hold on to their shares, and after they pay the dividend, people releases the shares. And I was asking that, is that only the case so that we can know when, although we are not supposed to time the market, but when is the best time that you can buy shares when customers are holding on to their shares?
Okay, so there are various categories of investors, various. So it is not all shareholders that will decide to hold on to the stock when dividends are announced. Some of them will just time the market when it's getting to the payment date. Okay, close to the payment date, then they sell. Some too, they want to sell with the dividend. So payment date is, we call it dividend. So they will hold on to the stock on the payment date. So on the payment date, or we call it the qualifying date, sorry. So the qualifying date, just on the date of the qualifying date, they decide to sell. So in the register, if you are in the register at the qualifying date, then you are qualified for dividends. And the buying side, there are investors too who would want to buy the shares when the dividends are announced. So as soon as they pinpoint the qualifying date, they want to be, because they want to be in the register of the company on the qualifying date, they make sure they buy it on that date. So these two categories of, or these various categories of investors, they have to reconcile at the point. They have to reconcile at the point. So it's very dependent and it's very diverse. And it's not general that you hold on to the shares or investors will hold on to the shares, but there are various reasons why people sell or various reasons why people buy. So based on this, the blend of the market activity will take place and then transactions will happen. Gabriel.
Okay, thank you so much.
You're welcome. All right, please, I have to attend to my meeting. All right, so meet again tomorrow. Tomorrow at the, no, I'll communicate the time. Make sure you are part of that meeting. Okay, thank you very much.
Thank you.